This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Monday, July 27, 2026, and this is the New York session. Now, let's get into it. The dollar just took a significant hit. June's advanced durable goods orders came in at 0.3%, missing the 2.5% expectation. That miss has fueled speculation of a more dovish Federal Reserve, pushing the euro up to 1.1414 and gold to $4,092. With the Fear and Greed Index at 14, deep in fear territory, and the FOMC meeting just days away, the market is positioning for a weaker greenback. But is this a genuine trend shift or just a pre-meeting pause? We're live on Monday, July 27, 2026. Let's get into the data. Before we dive into the charts, here is what you need to watch on the economic calendar this week. The highest impact event is the Federal Reserve's rate decision on Wednesday, July 29th at 2 p.m. Eastern. The current Fed funds rate is 3.63%, and the market is watching closely for any shift in tone given Friday's weak manufacturing data. On Thursday, July 30th, we have the ISM manufacturing PMI and the PCE price index, the Fed's preferred inflation gauge. These will tell us if the June miss was a blip or a trend. Also on Thursday, the Bank of Japan makes its rate decision at 7 p.m. Eastern. And finally, Friday brings the employment cost index. Apex, what is the key variable to watch in this setup?
The key variable is whether the Fed's reaction function changes. We saw the market price in a dovish turn on Friday's data, but the FOMC statement and the dart plot on Wednesday are the real test. If they signal that the June durable goods miss doesn't change their restrictive stance, we could see a sharp reversal. If they acknowledge the softening, the dollar weakness could accelerate.
Let's look at the live tape. The euro-dollar is up 8 basis points to 1.1404. Cable is up 3 basis points to 1.3354. Gold is down a fraction to $4,092.70. The Aussie is up 7 basis points to 0.6999. The Kiwi is at 0.5795. Dollar-yen is lower at 163.57. The fear gauge is at 14, indicating extreme fear. The headline moving markets today is the June Advanced Durable Goods Report. It came in at 0.3% against a 2.5% forecast. That was a significant miss. Pulse, how does this data point shift the macro narrative? It shifts the narrative from higher for longer to sooner rather than later. The Fed's target is 2% inflation. We're seeing CPI at 3.46% and core PCE at 3.41%. That's well above target. But with real GDP growth at 2.09% and unemployment at 4.20%, the economy isn't overheating. The durable goods miss suggests industrial demand is softening. Combined with the flat yield curve at plus 0.36 percentage points, the case for a rate cut at the July meeting is gaining traction.
On the technicals, that macro shift is playing out clearly in the euro. We're seeing the euro-dollar break above the 5-day high of 1.14358. The structure is bullish. The 5-day range is 1.13638 to 1.14358. We're currently trading at 1.14041, which is near the top of that range. That's a clean breakout.
The positioning confirms it. In the CFTC commitments of traders' data from July 21st, leveraged funds are strongly bullish on the euro, with net long positions at 1,209 contracts, up 1,363 week over week. Meanwhile, asset managers are net short, but the leveraged flow is driving the price. The smart money is betting on the Fed pivot.
But let's stress test that. The Fear and Greed Index is at 14. That is extreme fear. Historically, extreme fear persists. Just because the data is soft doesn't mean the dollar collapses. The VIX closed at 18.58 yesterday, up a fraction. Volatility is rising, not crashing. The risk here is that the market is pricing in a cut that doesn't happen on Wednesday. If the Fed stays hawkish, the leveraged longs could get squeezed hard.
Let's start with the euro dollar. It's at 1.1404, testing the 5-day high. Grid, you mentioned a breakout. What's the structure?
The structure is a higher high. We broke the 1.1400 psychological level, which was a resistance zone on Friday and Saturday. The 5-day low was 1.13638, and we've moved well above that. The current price of 1.14041 is holding near the 5-day high of 1.14358. The volume is supporting the move. This isn't a fake-out. The price action is decisive.
And the flows are behind it. I just noted the leveraged funds added over 1,300 contracts of long euro exposure. That's a massive influx of capital. But here's the counterpoint. Asset managers are net short 3,290 contracts, so we have leveraged funds pushing price up, while long-term money is still hedging or shorting. This divergence suggests the move is speculative, not necessarily structural yet.
The macro supports the leveraged view. The yield curve is flat at plus 0.36 percentage points. A flat curve often precedes rate cuts. The Fed funds rate is 3.63%. If the ISM manufacturing PMI on Thursday confirms the slowdown seen in durable goods, the Fed has little room to hold rates steady. The macro setup favors the euro.
I'm worried about the buy the rumor, sell the news dynamic. The euro is up 8 basis points today, but the fear and greed index is at 14. That means the broader market is terrified. Usually, when equity markets are this fearful, safe havens like the dollar and gold rally, not crash. The euro's strength might be a short covering rally rather than a long-term trend reversal. If risk sentiment sours further on Wednesday, the euro could fall back to the 1.136 level.
That's a valid risk. If we fail to hold above 1.1400, the next support is the 5-day low at 1.13638. That's a 45 pip drop. That's significant.
Moving to gold, it's at $4,092.70. It's been bid up on safe haven demand. Grid, what does the chart say for gold?
Gold is showing a consolidation pattern after a sharp rally. The 5-day range is $4,021 to $4,166. We're currently at $4,092.70, which is right in the middle of that range. The high was $4,116.48 on Friday. We're pulling back from that high. The structure is neutral to bullish, but we're losing momentum. The key level is the 5-day low at $4,021.86. If that breaks, we see a deeper correction.
The institutional positioning is interesting. Leveraged funds are strongly bearish on gold, with net short positions at negative 540 contracts, unchanged week over week. But asset managers are net long. This is a divergence. The speculators are selling the rally, while the long-term money is accumulating. This often happens at the top of a move. It suggests the smart money is taking profits, even if the price hasn't crashed yet.
The macro supports gold as a hedge. With inflation at 3.46% and real yields likely falling if the Fed cuts, gold becomes attractive. The dollar weakness also helps. But the fear and greed index at 14 means investors are fleeing risk assets for safety. Gold is the beneficiary. However, if the dollar weakens too much, the Fed might have to defend the currency, which could cap gold's upside.
Here's the risk nobody is talking about. Gold is at $4,092. That's a historic high. When assets hit all-time highs in a fearful market, they can be the first to sell off if the fear turns into panic. The VIX was at 18.58 yesterday. If equities drop, margin calls could force liquidation of gold positions. The leveraged shorts are sitting at negative 540 contracts. If gold breaks below 4,021, those shorts could cover. But if it breaks above 4,116, the leverage could snap.
I'm watching the $4,021 level. If we lose that, the next support is the 4,005-day low, which is $4,021. Wait, that is the low. The next level down is the open from July 23rd, which was $4,133. No, wait, the open on July 23rd was $4,133. The low on July 23rd was $4,004. No. Looking at the data, July 23rd low was $4,004. Wait, let me reread. July 23rd low was $4,004. Actually, the 5-day low is $4,021.86. The next significant level is the close from July 22nd, which was $4,133.59.
So $4,133 is the next key support.
Correct. If we break below 4,021, we're looking at 4,133.
Let's look at the dollar-yen. It's at 163.57. It's near the 5-day low. The BOJ decision is on Thursday. Grid, what's the technical setup?
The structure is bearish. We're trading at 163.57, which is near the 5-day low of 162.668. The 5-day high was 163.988. We've moved from the high down to the low. The current price is testing the lower bound of the range. If we break below 162.668, we could see a move toward 162.0. But the support at 162.668 is holding.
The COT data is overwhelmingly bullish for the yen. Leveraged funds are strongly bullish on the yen, with net positions at 1,209 contracts, but the week-over-week change is plus 97,394. That is a massive shift. The speculators have poured into yen longs. This is the same data point that drove the euro up. The smart money is shorting the dollar against the yen.
The BOJ rate decision on Thursday, July 30th, at 7 p.m. Eastern, is the catalyst. The current rate is 0%. If the BOJ signals a hike, the yen will strengthen. The divergence between the Fed's potential cuts and the BOJ's tightening is the key trade. The dollar-yen is a barometer for global risk. If risk sentiment worsens, the yen often strengthens as a safe haven.
The risk here is intervention. Dollar-yen is at 163.57. That's near the level where Japan has intervened in the past. If the yen strengthens too quickly, the Ministry of Finance could step in. Also, the fear gauge is at 14. If the yen strengthens, it's often a sign of risk-off. But if the BOJ surprises and stays dovish, the yen could weaken. The positioning is crowded. 97,000 contracts added in 1 week. That's a lot of leverage. If the BOJ doesn't hike, those longs could get crushed.
I agree. If the BOJ holds steady, the support at 162.668 could break. The bearish structure is intact.
Finally, cable, it's at 1.3354. The UK CBI retail sales data showed the smallest downturn in 6 months. That's a positive signal for the pound. Grid, what's the chart saying?
The structure is ranging. We're at 1.3354 near the 5-day high of 1.33953. The 5-day low was 1.32989. The price is oscillating in the middle of the range. The CBI data is a fundamental tailwind, but technically we're not breaking out. We're testing the upper bound. If we break above 1.33953, we could see a move to 1.34. But if we fail, we could drop back to 1.332.
The COT data shows leveraged funds are neutral on the pound, with net positions at negative 154 contracts, but asset managers are net long 16,284 contracts, so the long-term money is bullish, while the speculators are flat. This suggests the rally has room to run if the asset managers continue to buy.
The UK data is resilient. Retail sales are down, but the downturn is the smallest in 6 months. That suggests the UK economy is stabilizing. Combined with a weaker dollar, the pound has a natural bid. The BOE is likely to hold rates steady, but the data is not weakening the case for cuts as much as the US data.
The risk is that the UK data is just a blip. The CBI survey is only one data point. If the US data continues to soften, the dollar will fall, and the pound will rise regardless of UK fundamentals. But if the US data rebounds, the pound could fall back. The neutral positioning suggests there's no conviction. This is a range-bound asset right now.
I'm watching the 1.33953 level. If we break above, it's bullish. If we reject, it's bearish. The range is 1.32989 to 1.33953. That's 100 pips. It's a tight range.
Let's wrap with the Aussie. It's at 0.6999, testing the 5-day high of 0.70212. It's a high beta currency. Grid, what's the setup?
The structure is bullish. We're at 0.6999 near the 5-day high of 0.70212. The 5-day low was 0.69622. The price is testing the upper bound. If we break above 0.70212, we could see a move to 0.705, but if we reject, we could drop back to 0.698.
The COT data shows leveraged funds are strongly bullish on the Aussie, with net positions at 24,788 contracts, but the week-over-week change is negative 2,434, so the longs are actually reducing exposure. This is a divergence. The price is high, but the leveraged funds are selling. This suggests the rally is running out of steam.
The Aussie is sensitive to risk sentiment. With the fear and greed index at 14, risk appetite is low. The Aussie should be under pressure, but it's holding near the high. This suggests the dollar weakness is the dominant factor, not risk sentiment. If the dollar weakens further, the Aussie could rise.
The risk is that the Aussie is a proxy for China. If China's economy slows, the Aussie falls. The COT data shows leveraged funds are selling. That's a bearish signal. If the dollar doesn't continue to weaken, the Aussie could drop. The 5-day low at 0.69622 is the key support. If we break below that, we're looking at 0.693.
I agree, the support is at 0.69622. If we lose that, the next level is the close from July 23rd, which was 0.69670. Wait, that's higher. The next level is the open from July 22nd, which was 0.70005. No, the open on July 22nd was 0.70005. The low was 0.69802. So 0.69802 is the support.
So 0.69802 is the key level. If we break below, it's bearish. Apex tie it all together. We have a euro-dollar breakout, a gold consolidation, a dollar-yen bearish structure, and a ranging pound. What's the unified view?
The data is pointing to a weaker dollar. The durable goods miss, the flat yield curve, and the COT positioning all support a long dollar short trade. However, the extreme fear index at 14 and the crowded positioning in the yen and euro suggest this move is fragile. The FOMC on Wednesday is the catalyst. If the Fed confirms the dovish turn, we could see a breakout in the euro and gold. If they stay hawkish, we could see a sharp reversal. The key is to watch the FOMC statement. For now, the bias is short dollar, but the risk is a squeeze.
So the key takeaways. The dollar is weak after the durable goods miss. The euro is breaking out, gold is consolidating near highs, and the yen is strong ahead of the BOJ decision. The FOMC on Wednesday is the big event. Next week, we'll see if the Fed follows the data or the market. Let's hear the weekly calls for Friday, August 1st. The macro data supports a weaker dollar. With the Fed likely to cut or signal cuts, the dollar should continue to weaken. My weekly call, euro-dollar bullish, target 1.15 by Friday.
Technically, the euro is breaking out. The structure is bullish. I'm watching the 1.145 level. If it holds, we go higher. My weekly call, euro-dollar bullish, target 1.
That wraps up this edition of ShadowQuant Forex Edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.